can look at that chart and say, oh, there's the flat spot right there. You can't. And that's why we have numbers. And that's that one, you click on that one link and it brings up a list of those stocks. And those are the stocks that say, oh yeah, it's flat right there. And once we put it on, so we buy the straddle, we put it on at $10. Question is, how do we know 10 was the right price? So we got to answer that question. And then, how do we get out of it? And GM stock went up. We were able to sell some of our calls. In fact, all of our calls up here. We sold some of our calls up in here and sold the rest of them right here. And then we had the puts, and then the stock went way down there. So this is one of those instances where we made money on both sides. Okay. A strangle is ever so slightly different. Now you see this is a company called Blythe. This is, that's flat. You can look at that and see it's flat. You probably don't need any numbers to tell you that that's flat right there. But not everything's like that. A strangle is where you look at the strike prices. The strike prices are different. The expiration month is the same, and you're buying a call and a put, but the strike prices are different. And you choose a strangle when a straddle would dramatically bias the trade in one direction or the other. Now, I don't like strangles. I hate them. And you'll see why in just a second. Page 105. Again, the profit potential is unlimited. The break-even is the strike price of the put minus the debit. On the downside, the strike price of the call plus the debit on the upside. But if you remember the straddle was V-shaped, and there was only one point at which you could lose 100% of your money. But a strangle, the maximum loss is 270, so it's not very big, but you could lose it all over a range. So there is a possibility, a reasonable possibility of losing it all. And I just can't stand that. It just makes me ill. So I don't like them. And we're going to look at some trades. We're going to show you what I do that's a little bit different. Does anybody have a question on a straddle or a strangle, how they work? All right, good. This one, you know what these guys make? That stuff over there that's keeping the coffee warm. You ever hear of sterno? That's what these guys make. They make candles. Their annual sales, they make candles and sterno. Anybody ever hear of the company before? Yeah. You know what their sales are? $1.4 billion a year. Yeah, that's a lot of stuff. I mean, I couldn't believe it. I couldn't believe it. It's like, one of the biggest companies I've never heard of. I know them now because every time I've traded them, every single time I've traded Blythe, I've made money. So they're one of my favorites. Anyway. Yes? The question was, can you trade straddles and strangles on the internet? And the answer is yes, you can. For anybody that is interested in trading options on the internet, Let me just say one thing. Make sure the order doesn't go to the floor or to the market without somebody viewing it first. Because I promise you, if you make one little thumb mistake, you could end up losing your house. You know what I mean? You end up saying, I want to sell one, and you end up accidentally saying, I want to sell 100. In a stock, because there's no leverage, you can undo that mistake with very little pain. But with options, and because it's a margin account, I mean, if you say, I want to buy 100,000 shares of stock by mistake, they're not going to let you do it, right? If you say, I want to go short, and you're not approved, you don't have your margin account open, you can't do it. So there's some safeguards there. But if you have an options account, and you can do spreads, and you just accidentally hit sell when you meant to hit buy, you could end up losing your house. So don't deal with an online firm where it goes straight to the floor or straight to the electronic exchange. All right? That's one critical. Because I know a guy that did an online trade with E-Trade, and it's not anything against E-Trade, and it's not anything against the customer. He did a trade that calculated the margin requirements were $3,750, because that was the maximum risk in the trade, according to everybody. And he ended up getting a margin call for $500,000. Now that's a mistake. So you don't want that trade going to the floor without somebody knowing it ahead of time. All right? Okay. Again, this is the same step-by-step process. Find a stock with low volatility for no fundamental reason. Next, select the right strategy. Choose the month, choose the strategy. This is going to be a straddle or a strangle. Next, use the 100-day historical volatility to determine the fair value. Make sure the straddle price is less than 35%. Make sure the median, these departure signals are both large enough. And how do I do all that? I make one click of the mouse, and Odds Online does all this for you. One click. So make it easy. Here is the current price of the stock, $10.88. The straddle is, let's see, there are 86 trading days left until the options expire, until March. So there's the month. It's picked the month for you, the March options. Here is this 10 straddle, the strangle, the 10 put and the 12.5 call. And here's the other strangle that's just one strike out of the money. What we look here is the strangle has the lowest, what we call the break-even percent. What we do is we take the 1088. We then calculate the lower break-even, which would be 10 minus the $1.40, so that's going to be 860. We then take the 12.5, add the $1.40, which is 1390. So we compare 1088 to 10, and the 1088 to the upper strike. So here's the two break-evens, 1390 and 860. And we say, which one is the furthest in percentage terms? Is it 1088 to 1390 or 1088 to 860? And whichever one is the biggest in percentage terms, we put it over here. And we call that our break-even percent. So my guess is, just by looking at it, 1088 to 860. No, it would be 1088 to 1390, isn't it? Because that's a $3 difference, and the other's a two and change. So the 1390 is 27.76% away from the current price. So that's the break-even percent. Okay? How often does the stock move more than 27.76%? And we look back at previous signals. We look back at every instance in our, and the stock has had options on it for 553 days. So the options have been in existence for 553 days. What is the biggest move that the stock has made after one of those signals? And you can see here, the first signal in our database was March 2nd, 2003. The stock was $9.11. Well, there's 86 trading days between now and March options expiration. Let's look at an equivalent time frame. Back on the last time we got a signal, what was the highest close over the subsequent 86 trading days? And it was $19.77, which was a 117% gain. What was the lowest close over the next 86 days? And it was 1.98%, below the then current price. It took 86 days to reach that 117% gain. And so the maximum departure during that period was 117%. So the stock showed a tendency to move 117% during that, right after the last signal. The next signal was February 29th, or February 19th. It only moved 23%. And then the next signal was June of this year, and it moved 54%. So twice it moved more than enough to, well, once it moved more than enough to double the value of the straddle. The other time it moved enough to quadruple the straddle. And then one time it didn't move enough to even ever break even. You see that? That's what it means. What I want is, I want this number to be bigger than this number, so that every time we implement, if we had been able to implement a trade at this break-even percent in the past, every time we would have made money. That's what we're looking for. I want this number to be bigger than this number. That's the minimum departure signals. That's on page 107.